Are you ready for the next stock market crash? Do you know when it will happen and how to protect yourself from it? If not, you might want to watch this video because we will reveal some of the secrets and signs of stock market crashes and the latest developments and trends that could affect or trigger them. First of all, what is a stock market crash? A stock market crash is a sudden and substantial drop in stock prices across a broad market section. A combination of factors such as panic selling, overvaluation, speculation, economic bubbles, external shocks, or systemic failures usually causes it. A stock market crash can significantly negatively impact the economy and society, such as reduced wealth, lower consumer spending, higher unemployment, lower business confidence, and increased social unrest. However, not every decline in stock prices qualifies as a crash. There is no official threshold for a crash, but a common standard is a rapid double-digit percentage decline over several days in a major stock index, such as the S&P 500 or the Dow Jones Industrial Average. For example, on October 19, 1987, also known as Black Monday, the Dow Jones plunged by 22.6% daily, marking the largest one-day percentage decline in history. Another example is the 2020 coronavirus stock market crash, which lasted several months and saw the S&P 500 drop by more than 30% from its peak in February to its trough in March. So how can we tell if a stock market crash is coming? This question has no definitive answer, as crashes are often unpredictable and influenced by many hard-to-measure or anticipated factors. However, some indicators can help us gauge the level of risk and vulnerability in the market and the economy. These indicators can be divided into two categories: fundamental and technical. Fundamental indicators are based on the analysis of economic data and corporate earnings that reflect the underlying health and performance of the economy and the market. Some of the most commonly used fundamental indicators are the Shiller price-to-earnings ratio, also known as the cyclically adjusted price-to-earnings ratio. KPRE measures the valuation of stocks by comparing their current prices to their average inflation-adjusted earnings over the past 10 years. A high Shiller P or E ratio suggests that stocks are overvalued and may be due for a correction or a crash. Whenever the Shiller P or E ratio has surpassed and held above 30, it has been followed by a significant decline in stock prices. For instance, before the 1929 Great Crash, the Shiller P or E ratio reached a peak of 32.6. Before the 2000 dot-com bubble, it reached a peak of 44.2. And before the 2008 global financial crisis, it reached a peak of 27.4. As of September 1st, 20,237, the Shiller P or E ratio is 39.1, near its all-time high and well above its historical average of 16.8. The Buffett indicator, or the total stock market cap to GDP ratio, measures publicly traded stocks' total market capitalization concerning a country or region's gross domestic product, GDP. This indicator is named after Warren Buffett, one of the most successful investors of all time, who once said is probably the best single measure of where valuations stand at any given moment. A high Buffett indicator suggests that stocks are overpriced and may be in bubble territory. Whenever the Buffett indicator has exceeded 100%, it has signaled that stocks were overvalued and prone to a crash. For instance, before the 2000 dot-com bubble, the Buffett indicator for the United States reached a peak of 146%. Before the 2008 global financial crisis, it reached a peak of 105%. And before the 2020 coronavirus stock market crash, it reached a peak of 154%. As of September 1st, 20,239, the Buffett indicator for the United States stands at 207%, the highest level ever recorded and far above its historical average of 72%. The Consumer Price Index, PPI, measures the changes in the prices of a basket of goods and services typically purchased by consumers. This indicator is also known as the inflation rate. The S&P 500 has experienced a bearish divergence whenever there is a discrepancy between the price movements and the relative strength index, or SE, readings. For instance, before the 2000 dot-com bubble, the S&P 500 experienced a bearish divergence in March 2000. Before the 2008 global financial crisis, it experienced a bearish divergence in October October 2007, and before the 2020 coronavirus stock market crash, it experienced a bearish divergence in February 2020. As of September 1st, 2023, there is no clear divergence between price movements and RSI readings for the S&P 500 or the Dow Jones, as both indices are trading within a normal range of RSI values. These are some of the most widely used indicators to help us assess the likelihood and timing of a stock market crash. However, they are not foolproof and should not be used in isolation. They should be combined with other sources of information and analysis, such as macroeconomic trends, geopolitical events, market sentiment, and historical patterns. Moreover, they should be used with caution and prudence, as they can sometimes give false or misleading signals or fail to capture the full complexity and uncertainty of the market and the economy. So, what are some of the latest developments and trends that we should pay attention to and to anticipate and prepare for a possible stock market crash? Here are some of the most relevant and important ones. The COVID-19 pandemic is considered one of our most significant and disruptive events. It has resulted in unprecedented human suffering, social disruption, and economic damage on a global scale. Governments and central banks have implemented significant fiscal and monetary stimulus measures to support the economy and the market. But these measures have also created potential risks and challenges, such as rising debt levels, inflation, asset bubbles, moral hazard, and policy uncertainty. The COVID-19 pandemic continues to evolve, with new variants, outbreaks, lockdowns, vaccinations, treatments, and regulations affecting different countries and regions to varying degrees. The pandemic is likely to have long-term effects on the economy, market, and society, making monitoring its progress and the outcomes of related policies and responses crucial. The United States and China trade war is another major source of tension and uncertainty in the global economy and financial markets. It began in 2018 when the United States imposed tariffs on Chinese imports in response to alleged unfair trade practices by China. The trade war has affected various sectors and industries, such as technology, agriculture, manufacturing, energy, and consumer goods. It has also impacted other countries and regions that are part of both countries' global supply chains and trade networks. The United States and China trade war has raised concerns about global growth, inflation, currency fluctuations, geopolitical conflicts, and technological competition. Recent developments include the Phase 1 trade deal signed in January 2020 and the resumption of high-level talks in July 2021. But many unresolved issues and challenges remain. Technological innovation is another key factor impacting the economy and the market. Technology continually evolves, creating new opportunities and challenges for sectors such as biotechnology, artificial intelligence, blockchain, cloud computing, e-commerce, social media, cybersecurity, renewable energy, electric vehicles, and space exploration. Technological advancements can disrupt existing business models and markets, create winners and losers among companies and investors, and affect consumer behavior and preferences. Policymakers and stakeholders must address ethical, legal, regulatory, environmental, security, and privacy issues from technological innovation. It is important to keep track of technological innovation trends to anticipate potential opportunities or threats for different sectors or industries. These are some of the most relevant trends that we should pay attention to anticipate a possible stock market crash. However, they are not exhaustive or comprehensive. There may be other factors or events we have not mentioned or considered that could also affect or trigger a stock market crash. Therefore, we should always be vigilant, flexible, and ready to adapt to changing circumstances and conditions. So, to sum up, when exactly will the stock market crash? There is no definitive or precise answer to this question, as crashes are often unpredictable and influenced by many hard-to-measure or anticipated factors. However, some indicators can help us gauge the level of risk and vulnerability in the market and the economy, such as the Shiller P or E ratio, the Buffett indicator, the CPI, the moving averages, and the RSI. There are also some developments and trends that we should pay attention to anticipate potential opportunities or threats for different sectors or industries, such as the COVID-19 pandemic, the United States and China trade war, and technological innovation. You're first. By using these indicators and monitoring these trends, we can try to prepare ourselves for a possible stock market crash, or at least mitigate its negative impacts on our portfolio and our financial well-being. Thank you for watching this video. We hope you found it informative and useful. If you did, please give it a thumbs up and share share it with your friends and family. If you have any questions or comments, please leave them below. And if you want to see more videos like this, please subscribe to our channel and hit the bell icon to get notified of new uploads.